Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's Thursday, the 16th of March, 2023. Got a great guest for you. He's the author of one of my favorite books of last year that I read. I went through it in a weekend. Bringing on Nick Maggiulli. His book, Just Keep Buying. And I got to tell you, the book is just like that title. And I'll tell you, after reading it, I was so excited to be an investor in the market, be an investor in real estate and crypto and everything. Very positive book, but he breaks it down into very simple terms, backed up by great facts and great statistics. So coming up right now on Making Money, Nick Maggiulli. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. So here he is, the man I've been talking about, Nick Maggiulli, and the book, Just Keep Buying. And I got to tell you, when I saw the name of the book first, Nick, it popped up on my Amazon recommended list. I'm like, I got to love this book already because I'm the kind of guy, I'm an internal optimist. I just love that keep buying. Then I read the book and I was like, holy smokes, this guy's amazing. I mean, it was one of the easiest reads, yet so informational at the same time. You did a great job. And what I love about the book is it's a book that I've recommended to others at all levels of investing, whether you're not even in the market yet or you're deep in the market, because you've really broken it down. So first of all, thank you for getting that information out there, because it's only going to help people become better investors. But so I just want you to kind of get your synopsis. Why the name Just Keep Buying? Where did that come from?
So actually, it came from there's a YouTube video from Casey Neistat. I mean, if you've heard of him, he did a lot of vlogs back in the day. Lived in New York City, and he was talking to another YouTuber that was like giving him advice, a guy named Roman Atwood. And Roman Atwood told him just keep uploading. And so I saw this video like back in like 2017 or something, maybe even before that. And I was like, oh, that's kind of a neat thing. And at the time, I was doing a bunch of analysis on the stock market, and I was like, what if there's like I could use that idea, just keep uploading, but then apply it to like finance. And so I called it Just Keep Buying. I mean, it's like a rebranding of dollar cost averaging, because when you say dollar cost averaging, people's brains shut off. But it's like we're just rebranding it into I think a better philosophy than like what's been out there before. And I just show it with data. That's the whole idea behind the book. Is not like, oh, this is my opinion, this is what I think. Of course I have opinions in there that I can't prove every single thing with data, but I try to use data and evidence as much as possible to kind of prove what I'm saying.
Yeah, that's pretty amazing, because I agree with you. Like, it's you say dollar cost averaging and you lose people. Like, they're like, okay, I'm already scared of the stock market. This just made it even scarier. So you just have to break it down. So let's talk a little bit about your philosophy, your long-term investing philosophy, probably similar to mine. I when I buy a stock, I look out 5, 10, 15 years. I'm looking for a large trend and a company that's growing market share, that I think is a solid company that will continue to grow with this trend. Let's talk a little bit about your investment style in there.
Yeah, so I'm just buying income producing assets. That's the bulk of my, investable assets. I'd say 90% of those are income producing. That's going to include things like stocks, whether domestic in the US or developed, foreign, et cetera, emerging markets, whatever. That's going to include real estate, things like REITs, and for now, but eventually I'll own my own home and stuff. I live in New York City, so that hasn't happened yet, but one day. Fixed income right now, treasury bills are paying again. So now fixed income, I think, is a big piece of people's portfolio, especially if you're trying to save for a house or something like that. And there's a host of other income producing assets out there. Those are the big ones, stocks, bonds, and real estate. But there's other things you can buy. You can get into royalties. You can get into, investment properties, right? Versus just having your own owner occupied home. There's a lot of stuff I've heard about. I've heard about people buying vending machines and things like that. And so I'm not
Mhm.
as familiar with all the different income producing assets, but that's the bulk of my investable purchases. The other 10%, which I'm saying non-income producing, that's going to be stuff like, crypto, like Bitcoin, stuff like
Okay.
that. That's going to be stuff like art, buying things like that where, it's based on what other people are buying it for and not necessarily for any underlying fundamentals. Now, I'm not saying that there aren't any underlying fundamentals with crypto or stuff like that, but it's harder, right? It's not like a cash flow that I can go and I can point to and say this is a real thing, right? It's like,
Yeah.
it's like when I think of buying income producing assets, I think of like buying a suitcase that I know has a certain amount of money in it, right? Like, okay, the suitcase I know has 50 grand in it. So there are cases when, assets get bid down and people are selling that suitcase with 50 grand in it for $25,000, right? And that's very rare, but those have happened throughout history, right? But a lot of times when there's no money in the suitcase, you're just kind of, it's like a random thing. And that's why I think a lot of non-income producing assets are. I'm not saying you should never own them. I just think keep them a small portion of your portfolio, right? Or taking big risky bets, things like that. That should be the minority of someone's portfolio. So that's my long-term approach, the continual purchase of a diverse set of income producing assets.
I really like that suitcase analogy, and I'm probably a bit older than you, but I used to be a show called Let's Make a Deal back in the day. They pick three doors, and you weren't sure, like one might have a goat behind it, another one have a brand new car. It kind of feels like that sometimes. When you're investing in some of these riskier assets, you don't know what's behind that door. It could be a brand new car, or it could be a goat that you really don't know what the hell's behind there. And
Yeah, and
I
that's
probably
I got
lean
a
a. Sorry,
oh sorry,
go
go
ahead,
ahead.
Nick.
Yeah, so I got a lot of pushback from crypto because they're like, well, crypto is an income producing asset because all the yields, right? You can do yield farming, right? And I was like, we haven't done that long. Like, we don't know where the risks are, blah, blah, blah. And like, obviously, everything that's happened since, it's been very
Yeah.
unfortunate. But you can see, like, if you don't know where the yield's coming from, you are the yield, right? And so you kind of pick up on that. But yeah, sorry to cut you off. But yeah,
No, no,
keep
no,
going.
it's fine. And you make a good point, the crypto, Nick, because everything that's happened the last year and a half with FTX and Voyager and all the others out there. We learned that the 22% annual yield is a bit riskier than a lot of people thought. It's too good to be true. It usually is. Um, and I had on the show last week Howard Lindzen, one of the co-founders of StockTwits. You probably know of him, and he's a bit older than us. And he said he's now going to mention T-bills, getting a 6-year treasury for what, 5% is paying, somewhere around there right now. That's crazy. Like that's a really good return for somebody who's looking for very low risk and a decent return, especially to where we were years ago. So I think there's a place for everything out there you've talked about. And I think it depends on the person, right? What their risk tolerance is, what their goals are, what their age is, etc., what their income is. But when you have the income producing a layer on top of a good investment, boy, that just adds a little bit to the potential return that you're going to get on that. So you mentioned crypto. What is your view on crypto? Because you seem a bit to be a little bit more conservative, but you do believe in crypto.
I do have some of my assets in crypto. And I've been pretty consistent on this since 2017. That's kind of when it popped off and everything, or at
Yeah.
least when I discovered it. And I've kept a 2% allocation throughout that time period. And mostly it was just Bitcoin originally. I just had Bitcoin. And then my Bitcoin grew I got in at 8,000. It got to like 50 something. I sold half of it because it became too large. And I was just doing a standard rebalance, not like making market calls, not like some genius. I had no idea. I sold half of it 52. It then went up even more, right? So everyone said you're an
Yeah.
idiot. And then it kept going back and forth around 50 for a long time. Then obviously you had the crash that happened, in 2022. So I don't know what's going to happen next. I don't know. I said, hey, if you're going to do this, keep a small percentage. And I've kept 2% of my portfolio in Bitcoin. I actually had ETH for one point. I made money on it and then I lost money. So it doesn't really matter that much. Over on net, I've obviously made money because like I got in so early, but overall
Mhm.
I just keep a 2% allocation. I don't try to do market moves. I really just am rebalancing and just following that. That's my whole philosophy on that.
Yeah, that's my philosophy on cryptos as well. I have a certain percentage of my net worth in it, and same thing. I got in a little after you, but wrote it up, wrote it down, and I still believe in it. So otherwise, I'd sell it, but I still think there's a place for it. I think we need a little more regulation. I hate to say that, I'm anti-regulation, but a little more regulation will allow some of the institutions to come in and really kind of prop up Bitcoin, and the demand will go through the roof as supply stays very stagnant, in my opinion. But
Mhm.
let's talk about inflation. I mean, that was really the big driver of the markets over the last year or so. And maybe speak to inflation when we look at rising interest rates and how that kind of affects maybe even some of your income producing assets. Because Now, if we have the 10-year going up potentially above 5%, it makes some of the dividend yielding stocks or assets not as attractive sometimes in the near term. So, how do you consider inflation interest rates when you're making those decisions?
Yeah, so I actually wrote a post recently called, where to invest your money when inflation is high. And so I actually look through, going from back from the 70s onward, because that's when that was our last big period of high inflation. And, the best assets to own during these periods of high inflation are going to be equities, and it's going to be global equities, US equities, whatever. The just a general owning businesses, right? Because businesses can usually
Yeah,
pass on the cost of inflation, right? As they're seeing input costs, they can raise prices, right? So they can kind of offset that. It's inflationary periods are generally not good regardless. It's not like, oh, yay, inflation, buy stocks. Like, that's not what I'm trying to say. Inflation's generally bad. Like, high inflation is generally
yeah,
bad. But of all the things you can own, it's probably one of the best assets. So, like, yes, like treasuries are paying 5%. That sounds great. But what if inflation is 6%, right? So then, like, you're only losing 1%, which is, relatively not as bad to when treasuries were paying 1% and you were losing, and inflation was 7%, right? So you're losing
yeah,
6% or whatever, right? So you can see it's all like relative measures. And so people that are buying treasuries now, yeah, that's great relative to stocks, but like we have no idea what stocks are going to do in the next year, right? Stocks could be up a ton. And right. So like they already had a bad year. It's very rare that they have two bad years in a row. It has happened. Obviously, you can think of 2000, 2001, 2002 type stuff. Were we in that type of bubble? We can debate. But that's when I think about inflation, I'm thinking about like, okay, what you have to, I think you have to think more personally and locally. Like, what are your actual goals, right? Like, if you think inflation is going to stay high or even get higher into the future, the best thing you can do, and trust me, I'm not generally recommending this because it's a little risky, is like take on a lot of debt, right? Because if you take on a lot of debt
yeah,
and inflation goes up, right, your payment is fixed, right? But if your income can move with inflation, you own a business where the inputs are going to move with inflation, that payment's fixed, but your income's rising, right? So like the best thing you can do if you know there's going to be a hyperinflation or something like that is take on debt. I don't think there's going to be a hyperinflation. I would not recommend that approach for someone, but if you have that worldview, that is the best thing you can do because that money is going to just get depreciated away, right? And so that's kind of what
yeah.
you want, right? So just thinking about these types of things, what are you going to do, and how do you position yourself in this time? And I say just keep buying the same things you would normally be buying, and if you have a specific goal you're trying to reach, then you need to kind of maybe orient your portfolio toward that goal. So, like for now, I'm trying to save up for a house in the next year or so, maybe an apartment out here. And so I'm buying treasury bills. That doesn't mean like my 401k is
Okay.
still buying stocks and all the other stuff I've bought, but I'm just loading into treasury bills because I don't know. Stocks could go down another 10, 20% over the next year. And I don't
Yeah.
want to see my possible down payment decline. So I have to buy treasury bills.
Yeah, I managed money for 17 years, got out about a year ago, and I always got the question, "What's the best stock to own for the next 6 months?" I said, "If any financial advisor ever answers that, walk away, because nobody knows what the heck's happening, if anything, in the next 6 months, let alone next 2 or 3 years. Like, you don't know, like, where the market's gonna be. Over time, I'm pretty damn confident that the stock market's gonna be higher 10 years from now, but 6 months, who the heck knows? And, if you need the money, I always said, keep it in cash or somewhere, a CD or a T-bill, something you get out in 6 months if you need it in 6 months. That's the only place you're gonna be able to know that your principal's still gonna be there. Or,
Yeah.
go build, bury it in your backyard. But a lot of my audience is here at Stansberry. We have a lot of gold bugs, if you will, and I'm probably hated by most of them. I'm not anti gold. I just don't see a place for it in my portfolio. So I obviously you have a very diversified portfolio, from what I can tell. Do you have any allocation towards natural resources or gold?
So historically, I have, but I've once I started doing a lot of research on gold and actually digging into the numbers, like the thing with gold, I think gold can be something you can add to a portfolio and it helps with volatility, like over a very long period. The problem with gold is if you focus too much on individual asset classes, it is a very, very difficult hold for the long term, right? I've seen people do it with
Mhm.
trend getting in and out with gold, and I've seen some of that work. It's, the evidence is a little bit mixed there, but if you're like, oh, I'm going to hold it, you can have a 20-year real drawdown. And so in 20 years, you're not up on your position, right? Which is like that. I mean, of course, that can happen. That has happened with international markets and it's happened with other things, but like it is very rare for an asset class to be down for 20 years. But this is not uncommon for gold. And so I just don't think I could sit there and keep throwing money in there, keep rebalancing into it for 10, 20 years, when especially because it's not income producing as well. That's what makes it worse,
Yeah.
right? Like if the
Yeah.
stock market, if the US stock market is down after 10 years or 20 years, I have some fundamental belief in it. There's like people working towards something. Gold is just a big rock, right? So it's like, what am I actually getting? And so I think psychologically, I can't hold that for that reason. And so I think you have to evaluate yourself psychologically, say, am I the person that can keep buying this thing for 20 years? And I think it can provide a benefit. But if you can't do that for 20 years, even when it's still down from where it was, right? Then you're gonna bail early and you're not gonna get the benefit, right? So I think that's the
Yeah.
difficult part about gold. So if I'm gonna recommend gold to someone, I'm gonna say you really need to know yourself, because after 10 years of seeing gold drop, I mean, imagine we saw this happen. I think it was from the 80s was its high, and then it started going down, and then it didn't
Yeah.
hit its highs again, I think, until the 2000s or something, right? So it's like there was a 20-year period there where there's a real drawdown. And so in 1990, imagine yourself in 1990, could you have kept buying then even after you saw this huge decline? And that's the kind of the question you have to ask yourself.
And the other thing is in 1990, right? You're kind of in the midst of one of the greatest bull markets ever. So you're not only, I'm looking at a chart of gold right now. Through the 90s, it was flat to down.
Mhm.
Meanwhile, what is your opportunity cost? Would the Nasdaq go up 5 or 6x in that time frame? So it's
Yeah.
not the fact that you're just sitting there. You're also taking away some opportunity costs from other stuff. Not that you should be all in stocks and diversified, but still, yeah. I can't get the case for gold personally. That being said, it was back in, I want to say 2015. I don't know, some few years ago. We bought it, largest holding for our clients, but it was a trend play. Held it for 18 months and got out, made some money. But I agree with you. I'm not the long term type of holder when it comes to gold. But a lot of people just feel safer with it, Nick. So I just let them go with that. Um, you also talk in the book about risk a lot, and how do you view risk? Obviously, with your portfolio, you're diversified, a lot of different asset classes. For the average investor out there, I feel a lot of people take too much risk, and then you have other people that are so risk adverse they're afraid to even get in the market. What's the best way to tackle risk as an investor?
I guess every time we talk about risk, I think we have to put a time frame on that risk, right? Because most people, when they talk about
Mhm.
risk, they're talking about short risk. There's short risk and long risk. Most people are talking about short risk most of the time, right? Like, what's going to happen in the next 6 months to my portfolio, right? Like, can't I mean, obviously, last year we saw a case where fixed income got hammered, but that was a very special situation that I think will not be repeated for a long time because rates were so low and then they went up so quickly, which is like the worst thing that
Mhm.
could happen for fixed income. However, like you don't see, bonds drop off that quickly, but you can see stocks drop 10%, 20% in a month, things, or even worse. We saw 20% in a day, back in 1987. So when we talk about risk, it's about what risks you want to take and over what time period, right? So you can sit in cash and the next 6 months, the next year, your risk is quite low, but the next 30 years, your risk is actually quite high. So if you're sitting in cash for 30 years, the chance of you building wealth and actually preserving your purchasing power is basically zero. I think as a society, we've accepted that as a society of investors. We know, like, if I just sit in cash for 30 years, it's very unlikely that that's going to grow. So it's what risks you want to take and where. And you have to like kind of pinpoint the types of things that'll kind of make you possibly bail on a strategy, etc., and then set your portfolio accordingly. And so even in the book, like, I don't give someone, here's the perfect portfolio to own or here's exactly what you should do,
Mhm.
because I can't tell you your psychology. I can't tell you what's going to work for you, right? Like, I have biases against real estate because I saw both my parents, lose their homes in '08. So like, I know that's a personal bias. I know I'm biased against it. So I try to buy REITs to offset that, but I know I have this bias, and this is something that I think is a irrational belief I have. But other people, like, I love real estate. I make all my money in real estate. So I don't think there's anything wrong with using real estate or using stocks. I think you got to figure out what works for you. And so that's kind of my main take with risk is like, what's the type of risk you're taking and when are you taking it? So think about those types of things as you're kind of building out your portfolio and making decisions.
That's a great answer. I mean, it's a tough question, honestly. It sounds like a simple question, but it's a very difficult question to answer. And it's funny, I have a similar bias against real estate. I'm probably the only man in the last 20 years has like made money on only two properties and like broke even or lost money on other ones. I just have the worst timing, the worst pick of locations throughout the country. Finally moved my money to Nicaragua, so I'm buying down there. Hopefully that ends well. Let's knock on wood. But yeah, I've been really bad when it comes to trying to pick that. Um, you mentioned international investing earlier, Nick. Do you feel there's a place for that in most people's portfolios? Because I feel when I used to manage money, I tell people, okay, we're going to invest in Europe and Asia, and people have biases against certain countries for political reasons and stuff. But if I started going to some emerging markets, they well, it's way too risky. That government, this government. I always try to explain to them, well, look at our government. Our government, I'm a proud American, but our government on both sides is pretty messed up. So I don't want to really point fingers at other governments. How do you view international fitting into an average person's portfolio?
I think there should be some if you're doing equity exposure, I think you should have some international. Of course, what level, that's debated right now. And I just think you have to look through history, right? Like if you look from like the early 1970s through like I think it was like 2010 or something, US and international basically had the same return. I mean, they went back and forth. Sometimes international outperformed, sometimes US outperformed, right? Went back and forth. Like 2000, 2010, our emerging markets crushed it. The US did terribly because we were coming off the dot-com bubble. Then we got hit with the financial crisis, right, in '08. So it ebbs and flows. I'm not saying that's going to happen forever. We don't know. The other thing to take into account is like I was on a podcast yesterday and we were talking about this one pie chart which showed like in 1899 the US was like 15% of like the world market cap in terms of like its stock market. Today it's like 58%. Do I think 100 years from now the US is going to be 58 or 60 whatever percent? I don't think so. I think it's probably going to be a smaller percentage, not because I don't believe in America. I think the pie is going to be much bigger than it is, but we're going to have a smaller slice. And so who's going to take it? I don't know. I'm not saying that this is a bad doomer thing. Like, back in in 1899, the biggest slice of the pie was the United Kingdom. They had 24% of in 1899. Today they have 4%. So yes, that was an empire that was glorious. It is no longer a glorious empire, but it's still doing well. I mean, like, we think like the US empire, whatever you want to call it, is going to fail and then everyone's going to be homeless. I mean, that's not what's going to happen. Like we will still exist. We just won't be what we were, right? And so I think realizing that is kind of important and realizing that's probably going to happen to markets and it's normal and fine. And we don't need to panic about that whatsoever, right? Things change, people change, right? So that's the thing I want to emphasize there. So I think people should have some international stock exposure for that. Obviously from 2010 to now, US has very much outperformed internationally, but I don't know if that's going to be true going forward. And I don't want to bet everything, especially I live here. So like if the US starts going down the tubes in some way, that's going to already be tough. But then if my portfolio goes with it, it's even tougher. So
Yeah, it's kind of like working in a financial industry like you and I do and having all of our money in stock market. That if it goes down, our business goes down, and at the same time, the market goes down. You want to be diversified throughout that. And I think I was probably looking at that similar chart that you were came across my desk. I just pulled it up. It came across my desk this week, and looking at you have the New York Stock Exchange and Nasdaq, the two biggest as far as market cap for exchanges. But then you start, the next of the top eight, Shanghai, Shenzhen, Hong Kong, India are in there, and there's two Europeans in there. But you're right. I mean, it's a global economy. I know we've kind of moving to that nearshoring, onshoring a little more than we did a couple of years ago. But I agree. You must have exposure. So before I let you go, Nick, I ask every guest this question. You can answer in any way you want. Called the island question. I send you, your family, your friends, whoever you want to take, send you to an island for 10 years. No communication, no cell phones. You actually truly enjoy life. What is the one investment? It could be an asset class, it could be a stock, it could be a crypto, anything, or it could be cash. One investment for the next 10 years you feel very confident in, just walk away.
So I have to pick. So I can't have a portfolio. I could just have just one investment, like just one.
You could say a portfolio. You could say whatever you want, whatever.
I would take globally diversified stocks. I would pick like a whole world stock fund. That's what I would pick.
Okay.
Right. I'm bigger on businesses and business ownership than any other asset class for a host of reasons. And I guess it's what your goal is. If your goal is like, I need to guarantee the preservation of capital over 10 years, that's a little different than like, what's the highest expected growth? And like, there's a host of different questions there, but I would pick probably a global stock portfolio. If not, like what's going to be the best like inflation adjusted return? Maybe like a globally diversified real estate portfolio. I think it's a little bit less volatile, but it's between one of those two if I have to pick one of them.
It's tough because realistically none of us are picking one, right? We're gonna be diversified, but it makes it makes the question a little more fun if I have to try to drill you down at least one versus saying a diversified portfolio. But that's a great answer. And we've had some crazy answers, trust me, from all over the board. You would imagine what some people would buy for 10 years.
Yeah, some people it's all in on Tesla or who knows, right?
Exactly. Yeah. You know what's funny? After watching Tesla's Investor Day recently, I've always been a big fan of Elon Musk, and it was a boring investor day, which I actually liked. I feel like they finally, I love Tesla personally. I own shares of it. There's something about that company that I believe in them. Maybe I'm way wrong, but I've been giving speeches since Tesla went public years ago. And I've been on stage with guys smarter than me, more money than me, telling me Tesla's going bankrupt for every year for 10 years. and I've been right so far. So I'm
And
going to stick with my Tesla investment.
it's funny, I've heard the other side of that. So there's a guy on Twitter named Jason DeBolt. He's an all-in Tesla investor. Like all of his investable assets are in Tesla. Earlier this year, he was like, I'm selling my house to buy more Tesla. Like the price, it was like when the price was at 100 or something. Like, yeah,
Yeah,
he does crazy stuff like this. Everyone's
yeah,
dunking on him. And I'm like, you don't dunk on people like this because like this is a high vol asset and this thing can turn. And guess what? Everyone is quiet right now because this Tesla has done
yeah,
very well since then, right? So it's like one of those things where like you got to be very careful to like dunk on people on high vol assets because high vol assets go up and down really quickly. And I've seen it happen with Bitcoin. It's the same type of thing. And so
yeah,
you can't
exactly.
talk trash on something that has that much volatility because Tesla could be the biggest company in the world one day. It's very possible. I could also see it go
Yeah,
bankrupt. Like I could see both worlds happening somehow. It seems crazy, but I could see both. And that's you keeping
yeah,
that open
yeah.
mind is important.
Exactly, exactly. Well, awesome. Thank you so much for coming on. Again, just keep buying is a top 10 book of mine last year. So I just congratulate you. I know you sold over
Thank you.
50,000 copies, and keep up the great work. And I hope you're working on another one. Give me something else to read while I'm on the beach. So
We will
yeah,
see. We will see. So,
okay. Hopefully you got something else in the works. But thank you so much for joining us. We'd love to get you back on soon, and enjoy the rest of your day, Nick. Thank you so much.
okay. Thanks, Matt. Talk to you later.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.